You are listening to Uranium Spotlight on Tuesday, February 25th, 2025. Brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, Orano shifts their focus. Australia looks to open up uranium mining. India's private sector continues to aim at nuclear, and Cameco releases their year-end results. Last week, the uranium spot price closed at $65.65 per pound, down slightly from $65.70 a pound the week before. While this small decline may seem insignificant, it reflects the broader cooling trend we've seen in the market over the past month. Over the last 2 weeks, spot activity has remained moderate, with 13 transactions recorded, bringing February's total to nearly 3.2 million pounds U3O8. Early last week, prices softened as offers continued to outweigh firm bids, but midweek saw some stabilization, particularly at Cameco and Orano delivery locations. By Thursday, the daily price indicator firmed at $65.65, where it held up through Friday. Despite this slight recovery month over month, the uranium spot price remains down $1.75. Looking at the broader picture, last year's uranium market was shaped by strong term contracting, with long-term prices rising 22% to hit a 15-year high of $80 a pound. This was driven by supply concerns and increased utility participation, particularly from U.S. buyers, whose term volume surged by 50%. However, overall, term volumes dipped due to fewer large-scale contracts from non-U.S. utilities. Now, with the spot price under pressure and the long-term price holding firm, the key question is whether utilities step in to secure supplies or if uncertainty, driven by policy shifts and financial players staying on the sidelines, keeps buying interest weak. Either way, the gap between spot and term pricing remains a dynamic to watch in the weeks ahead. Since taking power in a coup in July of 2023, Niger's military government has grown increasingly hostile towards Orano and its uranium mining operations in the country. Now, Orano appears to be shifting its focus away from Niger altogether, prioritizing new projects in Mongolia and a planned restart of its mothballed mine in Namibia. Both moves aligned with rising uranium prices. Meanwhile, its operations in Canada and Kazakhstan, which have historically accounted for the bulk of its uranium production, remain unaffected. Orano is still pursuing arbitration to reclaim its assets in Niger, specifically the Somer mine and the Imamoran project, which was in the early stages of being restarted before both were seized by the government. Prior to the takeover, Orano had already faced challenges in Niger, struggling to export uranium and dealing with production shortfalls at Somer due to sanctions that restricted access to key supplies like sulfuric acid. Despite these setbacks, the French state-owned uranium major remains well-positioned. It expects its Mongolian project to come online within 4 years, eventually producing 5 to 6 million pounds annually by 2044. In Namibia, it holds a 40 million pound deposit and is targeting annual production of over 2 million pounds for the next 18 years. These developments, combined with its steady production in Canada and Kazakhstan, reinforce Orano's position as a diversified and resilient uranium supplier. In 2023, the company produced 17 million pounds of uranium, with over 11 million pounds coming from Canada alone, significantly reducing geopolitical risk. It reported $5.9 billion in revenue last year, a 23% increase from the previous year, and expects around $5 billion again in 2024. This figure does not include the $1 billion contract Orano signed with Japanese utilities to reprocess nuclear waste. Beyond mining, Orano is expanding its uranium enrichment capacity in France and has signaled potential plans to build a new enrichment facility in the United States, starting in 2026 or 2027. It's also exporting acquisitions of additional uranium assets with the backing of its owner, the French government, if needed. Given the tightening uranium market, persistent supply deficits, and increasing geopolitical risks, Orano's financial strength and production capability position it to capitalize on a rising uranium price environment. With an annual production capacity of 17 million pounds, only 2 million of which come from Niger, Orano's Namibian restart alone could offset those losses. Coupled with its Mongolian project coming online, the company appears well prepared to take advantage of uranium's long-term bull market. Australia holds the world's largest uranium reserves, just under 4 billion pounds. Yet, uranium mining is banned in 6 of the country's 8 states. That may be changing. A new poll out of Western Australia suggests growing support for uranium mining, a shift that could extend nationwide. Peter Dutton, leader of Australia's official opposition and currently ahead in national polls, has already voiced strong support for both uranium mining and nuclear power development. If Western Australia were to start mining today, it's estimated that the state alone would become the world's 8th largest uranium producer. Australia is already the 4th largest uranium-producing country, despite only 2 of its 8 states permitting mining. If all Australian states participated, the country could emerge as a top-tier uranium supplier, potentially playing a major role in addressing both the global supply deficit and the push for low-carbon energy, particularly as China ramps up its nuclear reactor build-out. Australia has a strong track record of safe uranium mining, with operations running for over 50 years under one of the world's most stringent regulatory regimes. Yet polling indicates that nearly half of Australians, or 46%, are unaware of this history. With strict oversight in place, the only real question for Australia may soon be how to manage the influx of revenue from utilities worldwide. India's shift towards private investment in nuclear energy continues to gain momentum. 2 major companies, National Thermal Power Corporation, or NTPC, and Vedanta Group, are now signaling their intent to participate in the country's nuclear expansion. Vedanta, a diversified mining conglomerate, has announced plans to power its operations with 5 gigawatts of nuclear energy, equivalent to roughly 5 Westinghouse AP1000 reactors. Each of these reactors would require about 500,000 pounds of uranium per year, adding up to 2.5 million pounds of new annual demand once fully operational. Meanwhile, NTPC, India's largest utility, with a vast portfolio of coal and natural gas plants, has set an even more ambitious target: 30 gigawatts of nuclear capacity. This could translate into as many as 30 large-scale reactors, potentially driving up uranium demand by 15 million pounds annually when fully deployed. NTPC has already put a price tag on this initiative, $62 billion over the next 2 decades. With more Indian companies eyeing nuclear as a long-term energy solution, the country's uranium demand outlook is rapidly evolving. We'll continue tracking these developments as they unfold. Cameco closed out 2024 with strong financial performance, driven by a tight uranium market and growing demand for nuclear fuel services. Annual net earnings came in at $172 million, with adjusted EBITDA surging 73% year over year to $1.5 billion. A key driver was the company's strategic contracting approach. Cameco now holds long-term agreements for 220 million pounds of uranium, while also capitalizing on soaring conversion prices. Westinghouse, which Cameco co-owns with Brookfield, posted a net loss due to purchase accounting adjustments, but delivered $483 million in adjusted EBITDA. With increasing global interest in new reactor builds, particularly in Europe, Westinghouse remains a long-term growth asset. Operationally, Cameco set a record at McArthur River in Key Lake, with 20.3 million pounds of uranium milled, the highest annual output of any uranium facility. However, supply disruptions at Inkai in Kazakhstan led to lower production and a temporary shutdown in early 2025. Cameco is monitoring the situation and adjusting sourcing strategies accordingly. Looking ahead, Cameco is maintaining production discipline, targeting 18 million pounds at each of McArthur River, Key Lake, and Cigar Lake in 2025, with flexibility to ramp up if market conditions can justify it. The company remains financially strong with $600 million in cash and a $1 billion undrawn credit facility, positioning it well for future growth. With uranium prices climbing and supply security concerns rising, Cameco appears poised to benefit from the sector's long-term tailwinds. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.